Good evening, everyone. Today I'll be speaking about the impact of global conflict on the Indian economy in 2026, what it could mean at a macro level, the key risks we should watch, the sectors that may benefit, and what senior management should do in response. At the macro level, India is expected to remain among the faster growing economies, but growth may still moderate because global uncertainty often reduces investment confidence and slows trade. We should also expect inflationary pressures, mainly driven by higher energy prices and rising logistics costs. Another important factor is the currency. Rupee volatility may increase, especially if risk of sentiments lead to foreign capital outflows and a stronger US dollar. Put together, these pressures can lead to slower consumer spending and more cautious corporate expansion, particularly in discretionary sectors. Now, the key risk to watch in 2026 starts with crude oil prices. If oil prices indirectly increases costs across transportation, manufacturing, and distribution. Secondly, global conflict can trigger supply chain disruptions, impacting imports of components, exports of finished goods, and overall production cycles. Third, if the US and Europe slow down, India could see weaker demand for IT services and export oriented businesses. Finally, there is a risk of higher interest rates and tighter liquidity, which can increase borrowing costs and pressure profitability across sectors. Even in challenging environment, some sectors may see accelerated opportunity. These include defense and aerospace, power and energy and renewables, gold and precious metals, domestic manufacturing, cybersecurity and digital infrastructure, and railway and infrastructure. Let's look deeper at defense and aerospace. With global defense budgets rising, India may see faster momentum in domestic defense manufacturing, supported by policy initiatives like Make in India, including defense systems and drones. We can also expect growth opportunities in surveillance, aerospace platforms, cybersecurity, and naval systems. Potential benefit in India include companies such as HAL, BEL, BDL, and shipbuilding related firms, depending on order flows and execution capability. Energy and infrastructure outlook is also likely to gain. Reason is very simple. In an uncertain world, energy security becomes a strategic priority, leading to increased investments in renewable transmission and domestic power generation. At the same time, government often use infrastructure spending to support stability and employment, so spending could stay resilient. As a result, railway logistics and EPC companies may continue to benefit, and especially those aligned with large public sector capex cycles. What does this mean for the senior management? From a leadership standpoint of view, the response should be proactive and structured. First, strengthen supply chain diversification, reduce dependence on single geographies, and build alternate supplier routes. Focus on cost optimization and work capital discipline because input cost and liquidity can tighten quickly. Increase geopolitical and currency risk monitoring, include hedging where appropriate. Re-evaluate investment priorities, shifting capital towards more resilient sectors and projects with stronger downside protection. And finally, enhance business continuity and cybersecurity frameworks because operational disruptions and digital threats tend to rise during periods of conflict. To conclude, India is expected to remain relatively resilient, but global geopolitical uncertainty can still create real pressure through energy prices, currency volatility, supply chain disruptions, and external demand slowdown. At the same time, selective sectors, especially defense, energy, infrastructure, and cybersecurity, may see accelerated opportunities. Ultimately, leadership agility, strong risk management, and disciplined capital allocation will be capital and critical to navigating 2026 successfully. Thank you and follow for more such videos.